In the first quarter of 2026, Singapore property transactions they fell off a cliff, like a 40% drop.
Yeah, it's a massive plunge.
Right. And by all laws of economics, when buyer volume crashes that hard, prices should be in free fall, you know? But instead, they actually went up.
I mean, it defies logic on paper.
It totally does.
Mm.
So today, we are figuring out how this mathematical impossibility is actually happening. Whether you're living in an HDB flat, mapping out your equity, holding a private property, and tracking your asset, or you're just a first-time buyer trying to navigate this landscape, this deep dive is built specifically for you.
Definitely.
Our mission today is to tear into the Q1 2026 market data and figure out the mechanics driving this. Because headline private home prices are up 0.3%. But volume has absolutely crashed to around 4,041 units. So, okay, let's unpack this. How can prices inch up when buying activity is just completely stalling out?
Well, the broader market is looking at that headline number, right? The 0.3% growth versus the huge volume drop. And they're assuming the engine is completely broken.
Right, because it looks like a severe contradiction.
Exactly. It's a massive statistical contradiction on the surface. But when you actually dissect the transaction layers, you realize the market hasn't stalled at all. It's recalibrating.
Calibrating how?
We're basically witnessing a radical shift into a two-speed reality. So that broad average of 0.3%, it's really just a mathematical illusion that's masking some immense volatility underneath.
Okay, before we get into the floor plans and the, District 9 price tags, I want to set the macro stage first, because we can't look at local real estate without understanding the broader economic gravity, right?
Sonny, you have to look at the macro.
So Singapore's GDP expanded 4.4% in 2025, which was a massive run.
Oh, absolutely. Huge year.
But the 2026 forecast expects a step down to 1.8%. So growth is clearly moderating.
Right. It's cooling off.
But on the flip side, inflation has also completely cooled. We're looking at a CPI of just 0.7%, and interest rates are, well, they're finally declining.
Which is the crucial part.
Right, but I'm looking at these two opposing forces here.
Mm-hmm.
If the economy is slowing down and MAS says growth is stepping down to 1.8%, shouldn't property prices be dropping? It feels like the engine is losing steam, but the car is somehow still speeding up.
Yeah. It's a great analogy, but if we connect this to the bigger picture, the interest rate decline is actually the dominant force here.
Really? More than GDP?
Oh, totally. Because of how it immediately alters the holding cost of an asset, we are seeing a massive return to positive carry dynamic.
Wait, positive carry, break that down for everyone listening.
Sure. So when interest rates drop below the rental yield, landlords are no longer bleeding cash every single month just to subsidize their mortgage.
I see.
Yeah, the rental income is completely covering the debt obligation. So when that mathematical threshold is crossed, desperation just vanishes from the market.
Because you aren't forced to sell.
Exactly. A seller has absolutely zero incentive to accept a lowball offer because, well, the property is basically paying for itself. That dynamic alone establishes a really formidable floor under prices, regardless of the broader 1.8% GDP forecast.
Okay, I get that. Holding costs explain why sellers aren't dropping prices. But it doesn't really explain the active price growth. If domestic growth is stepping down, the aggressive purchasing power has to be coming from an external catalyst, right?
You're spot on.
Because we've been tracking the geopolitical data, specifically the U.S.-Israel-Iran conflict that really escalated early this year. We're strictly looking at this through a capital flow lens, obviously, but global turbulence of that magnitude always triggers capital flight.
Always. And that capital flight has heavily, heavily targeted Singapore.
I mean, the numbers are staggering.
They really are. We've seen over 120 new family offices establish themselves here recently. Yeah, and concurrently, the top three banks received $77 billion, that's $77 billion, with a B in new money from ultra-high net worth individuals across Asia.
Which cements the whole safe haven status.
Precisely. But it's crucial to understand the mechanism of how this money actually impacts local real estate. A really common misconception is that these wealthy individuals are just flying in and directly buying up hundreds of luxury condos.
Right, because the ABSD, the additional buyer's stamp duty, makes direct foreign purchasing incredibly punitive right now.
Exactly.
They aren't going to take a massive tax hit just to park cash in a residential unit.
No, they're not buying the physical bricks directly in most cases. The impact is indirect, but it's massive.
So how does it work?
Well, those 120 family offices, they bring executives, they bring fund managers, specialized staff, and all of those people need premium housing.
Ah, so it's the rental market.
You got it. It creates immense high-budget leasing demand in the core central districts. That rental demand drives up yields, which makes the assets way more valuable to local investors who, importantly, don't pay that massive foreign ABSD.
Okay, that makes so much sense. So this tidal wave of global capital
Yeah.
creates an impenetrable safety net of rental demand,
Exactly, completely insulating the high-end market from any domestic economic moderation.
which sets up this structural floor for what analysts are calling the Goldilocks phase.
Right, the Goldilocks phase.
Because the frenzy of 2021 to 2024 is over.
Mm.
Buyers are no longer throwing blind offers at generic 10-year-old secondary market units, but the market isn't crashing either. It's not too hot, not too cold.
It's just highly, highly selective. Buyers no longer have that panicked, just get something first mentality.
Yeah, they've almost gone.
Completely gone. Today's market aggressively rewards precisely priced properties, and it severely punishes overpriced generic units.
And that brings us to, honestly, the most jarring data point in the entire Q1 report. The price gap between the CCR, the core central region, and the RCR, the city fringe.
This is a crazy statistic.
It really is. That gap has narrowed to just 10%.
10%.
Which is the slimmest margin since they started tracking this in 1995. A 10% gap between the city fringe and prime luxury.
It's wild. But to understand why this compression is happening, you have to look at the pressures applied to both ends of the market.
Oh, walk us through it.
So the RCR floor has been relentlessly pushed upward over the last few years by surging land costs and construction inflation.
Right.
Developers literally have to price RCR launches higher just to break even. Meanwhile, the CCR ceiling has been artificially capped by the government's aggressive ABSD hikes on foreign buyers and multiple property owners.
So the RCR floor is coming up, the CCR ceiling is pushed down.
And they squeeze together right in the middle.
Okay, I see the mechanics of the squeeze. But what does this all mean for you, the buyer? Why is this 10% metric so crucial when we talk about buyer psychology?
Because it fundamentally rewires the value calculation. Think about it. If you're an upgrader and you're staring at an RCR new launch priced at, say, $2,600 per square foot,
Okay.
and then you see a premium CCR address sitting at roughly just 10% more, you start wondering if you should just stretch your financing a tiny bit to secure a District 9 address instead of settling for the city fringe.
Right, because the friction of moving is so high anyway, you might as well cross that imaginary boundary.
Exactly. The CCR suddenly looks like a value play, which is a wild concept.
It is wild. And looking at the Q1 new launch performance data, it validates this two-speed shift perfectly. The extremes are just dominating.
Oh, completely.
Look at the ultra-prime extreme, River Modern in District 9. They cleared over 90% of their 455 units on launch day.
90% on day one.
At an average of $3,266 per square foot.
And that level of absorption in the core central region during a quarter with a 40% overall volume drop, it's a direct result of that 10% price gap psychology.
Buyers recognize the comparative value.
Yep, they saw the value and they capitalized on that direct Great World MRT access and the river views.
Right, so the ultra-prime extreme is moving rapidly, but the other extreme, the accessible Heartland OCR, that is moving even faster.
Oh, the OCR numbers are staggering.
Tenga Garden Residences launched 863 units. They sold 853 of them in one weekend.
Almost entirely sold out.
It's a 98.8% take-up rate at an average of $2,120 per square foot.
Insane demand.
And it's not just Tenga. Vela Bay in District 16 cleared 72% on day one at nearly 2,900 pieces. Pinery Residences in Tampines West drew over 8,500 people to their preview.
Yeah, massive crowds.
And Revel Tampines, which is an executive condo, sold 92.5% at launch at 1,839 PS. These OCR launches are just clearing out entirely.
And the demographic data behind that Tenga launch is really the key to understanding the current domestic market.
Why is that?
Because 90% of those buyers were Singaporeans. We are not talking about family offices or global capital here.
Right, no foreign money in Tenga.
Exactly. This is pure, highly concentrated domestic HDB upgrader demand. The developers recognize that local families have a hard ceiling on the total price of the quantum.
Right. They can only borrow so much.
So to keep a three-bedroom unit under that psychological $2 million barrier, while still charging over 2,100 PZS, they executed a very specific architectural strategy.
They shrank the footprint.
They absolutely did.
They stripped out the excess corridor space, minimized the balcony allocations, and engineered these hyper-efficient layouts to essentially mask the per square foot inflation.
Yep. And that 98.8% clearance rate proves that today's buyers are willingly accepting that compromise.
They'll trade sheer square footage for a strong location and an accessible overall price.
Precisely. But the speed at which these OCR units are vanishing creates an immediate crisis for the developers.
Because when you sell 850 units in a weekend,
Your inventory is completely gone. You have to restock the pipeline.
which brings us to the land bids. And here's where it gets really interesting. Because if developers are moving inventory this fast, they need more land. So we look at the government land sales, or the GLS pipeline.
And the raw data here is actually quite intimidating.
It really is. A Guaco Land-led consortium just won the Lenter Central GLS site with a record bid of $1,278 per square foot per plot ratio.
Which is huge.
Right. And the reason that specific number is a shock to the system is because it's 38.9% higher than the adjacent Lenter Garden site that was awarded just 1 year prior.
A nearly 40% jump in raw land cost for neighboring plots in a single year.
Plus, a Tanjongru site just shattered the RCR record at 1,455 PSF PPR.
Yeah, the land costs are just surging.
But wait, let me challenge this strategy for a second. The broader market transaction volume just plunged 40%, yet developers are paying 38% more for raw land. Aren't they taking a massive gamble here? It looks like corporate suicide to bid record highs when market liquidity is evaporating.
It looks like a gamble, but it's actually a defensive survival mechanism.
How so?
Well, a publicly listed developer cannot simply stop building. If they fail to secure land today, they have zero product to launch and zero revenue to report 3 years from now.
Right, they have to keep the machine running.
Exactly. They are forced to participate in the GLS auctions regardless of these short-term volume dips. And by aggressively securing that land, they establish a really rigid new pricing floor.
Because the raw materials are locked in at a premium.
Exactly. When you break down the financial modeling for that Lentor bid, you take the $1,278 land cost. You add baseline construction costs, financing rates, marketing.
And their profit margin.
Right, a non-negotiable developer profit margin. Analysts are already projecting that the future launch price for that Lentor condo cannot be lower than 2,700 PS.
Wow.
The break-even math simply won't allow it.
So it signals to you, the listener, that waiting for new launch prices to organically drop might be a losing game. The input costs are structurally guaranteeing the prices remain high.
Precisely.
But this brings up a massive mathematical hurdle. If an OCR condo in Tanga is clearing at over 2,100 PS today, and future Lenter launches will demand 2,700 PS, the cash outlay is immense.
It's massive.
And since 90% of these buyers are local, salaries alone definitely do not cover a $500,000 cash and CPF down payment. So the million-dollar question, where are local Singaporeans getting the cash to fuel these massive OCR new launch sales?
It's all coming from the primary liquidity engine funding the entire private property sector right at the public housing resale market.
HDB resale market.
Yes. The HDB data reveals exactly how this equity transfer works. In January, HDB resale prices edged up 1.2%.
Right.
And despite the whole seasonal dip we saw in February transaction volumes because of the Lunar New Year, the number of million-dollar HDB flats actually hit a new monthly record.
A new record in a slow month.
Exactly. And looking at the full year of 2025, the market absorbed a staggering $1,598 million flat transactions.
Nearly 1,600. It's like $1 million HDB isn't a unicorn anymore, it's a conveyor belt.
A conveyor belt is the perfect analogy.
Because a family sells a mature estate flat for $1.1 million, they clear their subsidized loan, and boom, they walk away with this massive pile of liquid capital and CPF. And that cash injection is immediately deployed as the down payment for the $2 million private condo.
Exactly. But for that conveyor belt to keep running at this kind of speed, it needs a continuous supply of highly desirable flats.
And that supply is coming.
What's fascinating here is looking at the MOP pipeline.
The minimum occupation period.
Right. The numbers for 2026 are highly anomalous. We have about 13,500 flats hitting their 5-year MOP mark this year.
Which means they illegally enter the open market.
Yes, and that is double the volume we saw in 2025.
Double. Wow.
Yeah, and based on absorption rates, we expect roughly 5,000 to 6,000 of those fresh 5-year-old units to change hands. But the true catalyst driving the premium pricing for these specific units is actually the new BTO classification system.
Okay, you're talking about the shift to the standard, plus, and prime location models. How does that policy shift bottlenecks the resale market?
Well, it creates a severe liquidity trap for aspirational buyers.
Yeah.
Because the new prime and plus BTO flats enforce a strict 10-year MOP.
Right, a decade-long lock-in.
And furthermore, when the owner eventually wants to sell, the government enforces a subsidy clawback, taking a percentage of the resale price.
Ouch.
Yeah. So if you're a young couple planning to upgrade to a private condo as your family expands, buying a prime BTO basically destroys your mobility. You're locked in for 10 years, and your future equity gets aggressively shaved by that clawback.
So to avoid that lock-in and penalty, these buyers are completely abandoning the premium BTO route.
Exactly.
They're forced directly into the secondary market to hunt for standard 5-year MOP flats that carry zero resale restrictions.
You've got it. You have this massive concentrated pool of high-income young buyers aggressively competing for this newly MOP-ed inventory. This concentrated demand hyperinflates the pricing of these 5-year-old flats.
Which allows the current owners to cash out at absolute maximum valuations.
Right. And then those sellers take that inflated equity and funnel it directly into the private new launch market, easily covering those 2,100 PSF price tags at places like Tenga.
It's a perfectly insulated, self-sustaining loop of domestic equity.
It really is.
Okay, let's synthesize all of these distinct mechanisms into some actionable strategy for you, the listener, right now. Because this two-speed Goldilocks environment is tricky.
Very tricky.
If you are currently attempting to sell your property, the data indicates that market tolerance for aspirational pricing is basically zero.
Zero.
You cannot list your unit 10% above recent valuations just to, test the waters. You are actively competing against highly optimized, aggressively marketed new launches that are absorbing all the available equity.
The secondary market demands total precision right now. Generic, overpriced units are just getting ignored.
So if you genuinely want to transact, you must price to sell within 5% of proven market valuations.
Absolutely.
But conversely, if you are a buyer operating the secondary market right now, you actually hold a distinct tactical advantage.
You do, because with overall volumes down 40%, sellers who are facing genuine timeline pressures are highly receptive to negotiation.
You have the best negotiating leverage we've seen in 5 years in the resale market.
Right. But that leverage completely vanishes if you step into a primary new launch show flat.
Totally. Because developers have cracked the Canadian quantum pricing.
They have. If you find an efficient layout that fits your budget in a strong location, hesitation will cost you the unit. I mean, the 98.8% clearance rate at Tenga proves that optimized inventory does not sit idle.
You have to be decisive.
You have to execute. But, there is a broader philosophical shift occurring beneath all of this data that we really need to address before we wrap up.
What's that?
Well, we've detailed how developers are methodically shrinking unit sizes to keep prices affordable, and simultaneously we're watching raw land costs surge by nearly 40% in a single year.
Right.
So we are engineering a market where the physical dimensions of housing are contracting while the financial inputs are exploding.
Which forces you to look at the long-term trajectory of the upgrader.
Exactly. I want to leave everyone with a final question to ponder. If a local family stretches every dollar of their HDB equity to secure a hyper-compact 3-bedroom OCR condo today, what does their next move look like in 10 years?
In 2036.
Right. If land costs continue to establish higher floors and the per square foot metric completely outpaces wage growth, will the sheer cost of land make upgrading to a larger space impossible?
Are we transitioning into an era where upgrading in Singapore no longer means getting a bigger home for a growing family, but simply getting a newer one of the exact same size?
That's the defining question. The data suggests we are rapidly approaching a reality where space itself is becoming an obsolete metric of progress.
Wow. That completely redefines the Singaporean property dream. The underlying math isn't just dictating the prices, it's dictating how we physically live.
It's a structural change.
The 40% drop in volume isn't a glitch in gravity. The atmosphere of the market is just becoming vastly denser. It requires substantially more financial fuel just to maintain your current altitude.
Well said.
Thank you for joining us on this deep dive into the Q1